What's coming next week could send stocks plunging, and as you're about to see, no one's ready. I'm Steve Van Metre, and what's about to trigger this nightmare? Well, it has everything to do with the biggest buyer of stocks and them going into blackout. Now let's head over to Goldman, where we set today's story up, because I want you to understand the last 2 weeks going into every quarter, the biggest buyer of stocks go into blackout. And the problem for last week, they've been massive buyers despite a downturn. And with them going into blackout, the risk is we could see stocks plunging. And buybacks remain at elevated levels. That was up 10% over fiscal year 2024, according to Goldman. But there's a big risk, because not only are they the last major buyer, there's someone else who's been buying the dip, and that's retail. But the challenge here is you're about to see the machines have been big sellers, and not only that, the pros are selling as well, and the risk now to the market squarely to the downside. Let's take a look at machine positioning, because this is critical to understand. There could be another big wave of selling when stocks break a critical level. Let's take a look, because over the next 1 month in a flat tape, assuming stocks just go sideways, the machines are going to sell about 47 billion of global equities, 20 billion of that out of the S&P 500. In an outright down tape, they could be sellers of 126 billion of global equities, and that would cause the markets to plunge in a big way. Now, here is the key level that you need to be watching. It's 54.37 on the S&P 500. If it breaks this level, what's going to happen is the machines are going to sell, and sell in a big way. This is going to create a tremendous amount of opportunity. We're going to look at that in a bit, but I want to show you what the major risk for next week is, and it's right down here. You break this level, and that is the line of no return from the machines. They're already set up in a short position. If that breaks, they're going to go all out max short. It's going to send stocks plunging in a big way, and that's going to create a lot of opportunity. But in the meantime, that's what you need to know. That's the major risk, because it's not just the machines are going to sell. We're going to see other systematic positioning unwind as well. The risk here is if volatility goes up, you can see systematic positioning across U.S. equities still remains at a relatively high level. It's not at a buy opportunity, because when you factor not just the CTAs, but the risk parity models and the vol control funds, what happens is if we see a spike in volatility, a stock sell off, they're going to go into protection mode. They're going to sell off in a huge way, and that's going to create a tremendous amount of upside opportunity. But the risk is in the short term. And weakness in funding spreads in weeks following the December FOMC meeting highlighted a decline in professional investor positioning. It led us to be concerned about downside asymmetry in equities. Now, at the same time, we're seeing professional investors start to sell and hedge the downside risk of the market. What we're seeing with retail investors is they were big buyers last week. They think going into earnings season, there's going to be upside surprise. But I want to keep you in mind, keep this in focus, is we've talked about how all the experts, all the analysts have set the bar very high for future earnings seasons, meaning they want the market to go down. Remember, a lot of the CEOs and executives have been major sellers here. There's a reason why we're seeing positioning shifting here in retail. They've yet to sell, and when they do, watch out. There's going to be great opportunities in this market. While funding spreads have stabilized, they're at a much lower level, suggesting demand for equities in the futures market has significantly declined. Let's take a look, because when you see funding spreads, these are professional investors. They have backed off the long side of the market. That's why we're seeing the S&P 500 shown here in blue come down. The risk is, you can see that when pros are backing out, it means the downside risk to the market is huge. You can see it could potentially easily break that critical CTA level, lead to a flood of selling, which would then trigger the risk parity and vol control models. And we could face ourselves with not just a mild correction, but a massive correction in the market. Oversold technical conditions are now primed for a rebound, but rallies will be used as selling opportunities, giving strong headwinds facing the market. Now, this is from a Goldman report. They're telling their professional subscribers, look, any rally in the market is going to be sold here. But who's buying? Again, it's retail. The challenge here is you're going to see from a B of A report, when retail starts to sell, it's going to create a tremendous opportunity in this market, because the pros are out before them. Let's take a look, because according to Bank of America, they say this is just a correction. and correction history suggests the S&P 500 is a good buy at 5,300, particularly as fund managers' cash level surges above 4%. So that's a key metric we're going to be watching on the show. But keep in mind, if the market gets down to 5,300, you're going to see a wave of machine selling. Now, despite the fact the market declined last week, what we saw is stocks did see an outflow, 2.8 billion. But look at this, retail, private clients, they're buying the dip. In fact, it was the third largest weekly inflow to equities ever. So while the pros are selling, retail is buying, and that's going to be a big risk because retail thinks earnings are going to beat. The pros say they're not. And that's a huge risk because once retail realizes they're on the wrong side of the market, what you could see is a flood of selling coming. Now, I want to know what you think. Do you think retail's buying the dip? They've got this nailed and the pros are wrong? Or do you think the pros are right and you're on the sideline looking for a bigger opportunity? Weigh in the comments below. If you're enjoying what we're telling you here, hit the like button if you're looking for a big opportunity to buy back into the market. Because again, this is our Sunday show. We take a look at the technicals, momentum, and machine positioning to help you make more money investing and trading. And we've got some opportunities, big ones here for you, because amidst all this chaos, even in the downturn, I'm going to show you how to make money. Now, if you want to understand why retail is buying the dip here, they see a tremendous opportunity. Market breadth, we're seeing a 3 standard deviation move to the downside with about 41% of the S&P 500 trading above this 200-day moving average. So again, if you're a dip buyer, if you're looking at breadth, this is a huge opportunity, but the machine's still looking to sell. Now, let's take a look at our screens here because broadly speaking, momentum is negative. Now, when you take a look at momentum, you have to look at technical indicators like the relative strength index or RSI. It's at 38. Now, when it's under 40, momentum's negative, so you want to see a positive move above 40. How about the moving average convergence divergence or MACD? You want to see a positive cross. Right now, it's negative. But when you look at technical signals alone, you can't just go based on them because the risk here is you can see things go from an oversold condition to further oversold. Now, when you pair the trend in play, as we do with our Momentum Timer Pro product, you see 16 consecutive daily sell signals. Now, it's important to understand over our 1 month window, we see a sell max here. So we're telling our subscribers, this isn't where you want to buy. Now, from machine positioning, we run a screen on that as well. We look at a historical overlay. We see on our fast algorithm, machines max short. Our slow algorithm, machines max short. Now, this is critical because when we see shifts in machine positioning or momentum, we alert our subscribers. And guess what? You can take advantage of that too. Hit those links in the description below. Grab the 30-day free coupon code because this is going to be a major opportunity to make money in these markets. We're going to show you where you should be positioned now, and we're going to tell you when it's time to take risk. We're not there yet. Let's take a look at the charts now of the S&P 500, the largest SPY, and let's see where the technicals are telling us because again, you see this little bounce here. You see all of this volume that came in. This is retail buying the dip as professional investors sell. Now, again, I want to know from you, what are you doing? Are you buying the dip here? Are you selling? Are you on the sideline? What's your take on this market? What are you doing? I'd love to hear from you. Weigh in the comments because it's possible we will see a rally back up to the 200-day moving average. Now, the risk here is if the 200-day moving average acts as resistance, you're going to see a much bigger move down in stocks. Potentially, if the machines win out next week and corporates go into blackout and are unable to buy their stocks without all of that buying pressure putting support underneath the markets, we could see a bigger drop. And keep in mind, corporates, massive buyers here. And speaking of massive buyers, let's talk about NASDAQ because that's where the big tech companies are. And again, you want to see a buy the dip opportunity. Why people are buying here? You have a 4 standard deviation move to the downside in breadth on the NASDAQ 100 with just under 42% of it trading above its 200-day moving average. But from a technical position, momentum is negative. RSI is at 38. MACD, again, negative cross. 16 consecutive daily sell signals. And again, it's not until we see a move off of this big max sell signal or 1 month window that we should even start looking at upside opportunities. Let's take a look because the downside risk is now 457, if you can imagine that. And of course, our machine positioning has said and told our subscribers, look, this is a market you should be out of a long time ago. Now, let's turn on the volume on the side here so we can get a clear picture of what's going on. 457, that's down here in this big chunk of volume over the last 1 year. You can see volume support at 440. Because something that's important to understand is when you have a long-standing rising trend, people have been buying the dip on the way up. And as it breaks certain key levels, what happens is people want to protect their gains. They don't want to gain a lost position, and they look to sell. And that's why you can see large moves to the downside, despite the fact that the market is technically in an oversold position. Doesn't mean it can't get worse. Let's talk about the Russell 2000. It's at a 3 standard deviation move to the downside when it comes to breadth. But look at this, about 32% of its stocks are trading above its 200-day moving average. So again, short-term opportunities that may not play out. Again, momentum's negative. It's been that way for the last 18 consecutive days. We've got a huge sell max on our 1-month window. Machine position, again, we've told our subscribers to be short. If you're looking to go long, this is not the market to do it yet, but wait, when it happens, we're going to be the first to tell our subscribers, and they're going to take advantage of that upside move, because look what happened. After the election, the market surged up. We said, no, look, this is a big topping pattern, and look at the 1-year volume profile. Despite the fact that people were buying up here, you had a lot of people selling. Now the sellers have won out. Let's zoom out to the 2-year chart, and what do we see? Right down here into this 190 zone, and you can see the 2-year volume profile in red acting as a zone of resistance to the upside, suggesting another move down in small caps is coming. The risk, again, to the market is to the downside. So how do you trade this? How do you make money? Well, let's continue on, because everybody's looking at the energy market. Well, and oil prices are set to settle lower as the IEA warns that trade tensions will undercut demand. We made money trading energy. We tell our subscribers, well, right now is not the time. Even though momentum turned positive on XLE, we told our subscribers this isn't the trade for you. We said hold off, and I'm going to show you why. RSI is up, MACD is up, so momentum is to the upside, and trend is validating it. But just because you have all of that doesn't mean you should buy. I'll show you why. Even machines are buying here, but there's an issue. Demand from the economy is weakening, my friends, in a big way. And when that happens, well, the energy sector, it tends to go down. And look at this. We're on that 6-month chart. Do you see the red line? That's the volume profile. Above that, you see sellers. Below that, you see buyers. So what's happening is people are coming in and buying the dip in energy, and they're running right into resistance here. This is why we told our subscribers you don't want to be buying the energy sector just yet. This is telling us the signals are wrong. Resistance right overhead. But how about the banks? Everyone was bullish on banks on the fact that interest rates were going to come down. We said no. Look at this headline. Robinhood, banks and brokerage stocks tumble again on economic concerns. Sounds like what we have been saying. And how about this? The RSI is at 40. Now, it's right on the cusp of the difference between positive and negative momentum. But look at the MACD. It's saying momentum to the downside. How about momentum time pro? It's validating trend to the downside in addition to the momentum signals. And how about machine position? You're looking at max short across the board. This wasn't the trade for the upside, but a lot of people jumped in on the financials. Let's take a look and see where XLF is at and why. We told you, don't buy at the all-time high. Remember, we told you this wasn't the place to go. There's other opportunities. You can see financial stocks came down. They're hitting a level of support where buyers were at before. Where's the upside resistance? It's 49.67. There's that 6-month volume profile. If it gets rejected there and cannot find buyers, well, what happens is you're looking to move down to the 200-day moving average, and from there you don't have a lot of volume holding up after around 45, and then you're down to 41. Banks not looking like the place to be. But again, there's other opportunities in this market. JP Morgan downgrades Mexican stocks, ups ratings in Brazilian equities. But guess what? We told our subscribers to buy this back on March 10th. That's right, on our last Sunday show, we told our subscribers this was the buy. Despite markets going down, our subscribers were up over 5%. There's 5.17% now. Momentum is starting to see a shift, but it was machine positioning that was the trigger here. Let's take a look at Brazilian equities. Again, this was a great opportunity. And again, if you're a subscriber, this is one you could have taken advantage of. Best part is there's a 30-day free trial, so you didn't even have to pay. You could have made money. And look at this. We told our subscribers to buy right here on the 10th. How did we know that? We saw momentum signals moving to the upside. We saw the trend moving to the upside. But more importantly, it was the machine positioning that we noticed, and there was volume support underneath it. You can see the 10-day window. That was our trigger point, and now you can see it trading above its 30-day volume profile. Let's take a look at the 90-day. It's above that, and as we just saw, closing above the 6-month. Again, there's still opportunity here. We're looking at a trade up here around 2740 or about the 200-day moving average. But again, great opportunity. You could have taken advantage of this just using our signals. But the market's fixated on emerging markets as Chinese stocks also see largest inflow in February. Let's take a look at emerging markets. We said instead of EEM, go with Brazil. But let's take a look because momentum is positive here. RSI is up at 57. MACD hasn't validated this yet, but the trend has. We'll take a look at the chart here in a moment. Machine positioning somewhat long, not max long, but still getting there. How about momentum? Well, it's been oscillating between buy and sell signals, so nothing with a lot of conviction here. But let's take a look at EEM because this is interesting. You see 6-month volume profile acting as support, whereas Brazilian equities we think has a lot of upside. In comparison here, I'm not as convinced. Now this could get up to 46.14, but again, I like the setup in Brazilian equities a whole lot better. I think it's a much stronger picture. Let's continue on because Bank of America said go long the long bond, and money's flooding into it, but its price isn't moving. Now let's take a look at where we're at. We last told our subscribers to buy it back in on January 31st. We got stopped out for a small gain. Now you'll notice here, why are we down 3.3% on this trade? Well, there's a good reason, because we want to show you the importance of using risk control or stop losses on your trade. Because if you find yourself down in a position, well, there's one opportunity you have, and that's to dollar cost average back in using our signals. And we're doing that, but well, so far it's not working out too well at the moment. Again, our cost base is at 93.25. Machine positioning was max long here. In fact, again, our subscribers got stopped out, so we'll be looking for another opportunity to enter into the long bond. Let's take a look at TLT here, because again, there's going to be opportunity here, but you'll notice the 6-month volume profile is acting as overhead resistance. What we really want to see here is it holding that 50-day moving average, because when a trend is changing to the upside, you look for a cross of a major moving average. In this case, the 50 days in green, and then you look for confirmation, meaning price comes down and holds the 50-day moving average. There's your upside move. So we do see a little downside play in long bond here. Technically, we're seeing momentum slow down, but the upside move then would be up here to around 94 with a breakout up into 100. So there's a lot of potential in the long bond. We're just not there yet. But again, our subscribers will be all over that. And something you were all over is gold prices. Now, we made money in the minors. In fact, we still have an open position on the juniors, but gold prices are smashing record highs, but still a risky bet. One expert says you're not sending gold to buy your Domino's pizza. Well, weigh in the comments, what do you think about that? Because let's take a look at gold here. RSI is at 67. MACD's got a negative cross. We didn't trade this because we said if you want to trade gold, trade the miners instead. There's a lot more upside. Let's take a look at GDX. Now you're going to say, wait a minute, I don't see a position here. You're right. We had a position on the junior miners, and that is up. Our CTA subscribers took advantage of that in a big way. Let's take a look where I think the miners are headed here. RSI is at 66. MACD's got a positive cross. You have 2 consecutive days of buy signals, meaning momentum has been oscillating back and forth because the trend is not consistent here. Machine positioning fairly stretched to the upside. Let's take a look at GDX, because if you're looking to chase the miners at this level, well, there's a big problem, and it's called a potential double top scenario here at 44.22. This is what we told our subscribers as well. This is maybe a trade you don't want to add into right now, but if you have it, well, hold on to it and raise your risk control levels. Keep those stop loss levels tightened up, because the ag industry faces multiple fortunes amidst strong cattle market, slumping wheat prices. Well, it's interesting because wheat, well, we just put that trade on just last week on the 14th. To our CTA Timers Pro subscribers, it's down 0.61%, but I think there's a lot of upside here. And one of the important things to understand is the markets make the news doesn't make the markets. And so right now, the markets, as you're about to see, the position is looking interesting here for a trade in wheat. RSI back in positive territory, above 40 at 46. MACD looking to make a positive cross. Trend hasn't validated yet. Momentum time process holding off on for a momentum trade here with 13 consecutive daily sell signals, but machine positioning buying, that was our signal. Upside target 510. Let's take a look at this chart. Again, we're talking about upside potential. Commodities in addition to potentially bonds and Brazilian stocks. Well, that one's doing very well, but let's take a look at wheat here, because look what's sitting underneath it, the 6-month volume profile. Let's go deeper. Let's look at the 10-day. You have support just at the 10-day as well. How about the 30-day? You have support right there. So you're looking at a critical point that could send wheat higher, trading above its 90-day volume profile. So while the news says perhaps wheat isn't the trade, we're telling our subscribers, hey, look, you've got support underneath here, upside potential right here at around $5.14. That would make a great trade. But keep in mind, if you're looking to take advantage of this market, we see big opportunities coming. Again, we showed you how you can take advantage in this down market and where the position is going to be. We're going to show you when it's time to go long the U.S. equity market. And keep in mind, if we see a break of that critical CTA sell signal, watch out. There's going to be a whole lot more sell in this market, particularly when the machines drive retail investors to sell. It's going to create a great entry point, or what's called a potential bear market rally. Again, hit the links in the description below. Grab the free 30-day free trial, because again, we want your first 30 days on us. That's how confident we are you can make money. We think it's going to be big opportunities for you to take advantage of. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.